Today we're going to talk about 3 common misconceptions of mortgage lending and how having the correct information may help you close more transactions. Today we're going to talk about 3 misconceptions that most realtors think are truths or facts when it comes to mortgage lending. 2 of those pertain to the type of borrower that we'd be working with as a lender and you'd be working with as a realtor, and the other pertains to the type of property that individual will be buying. So first we'll talk about your regular W-2 buyer or borrower. This is someone who works for a company, is paid with a W-2. Now, you might have a borrower who does a lot of traveling or is in the sales business, and they have unreimbursed business expenses reporting on their tax return. Well, typically, we'd have to hit their income for those unreimbursed business expenses, which would actually reduce the amount of mortgage that they qualify for. But that's simply not the case when it comes to our W-2 only program. This program only requires the W-2s for the last 2 years, as well as the most recent 30 days worth of pay stubs, eliminating the need for the 2 years of tax returns that most individuals think are required. This helps you avoid the 2106 unreimbursed business expenses even being factored into the qualifying income. The second type of borrower is a self-employed individual. This is someone who either has their own business or is paid with a 1099 from a business. This person might have been told by their bank or another lender that they don't qualify for a mortgage because they don't show enough income when averaging the last 2 years of tax returns together. But it's simply not true that they necessarily need 2 years of tax returns to qualify. We're able to get those loans done in many instances using just 1 year of tax returns. This is the difference between someone qualifying for a home that they love and having to walk away and wait another year to buy a property. This actually can help you close a transaction that you might have thought was impossible until next year, because we're able to get this done with just 1 year of personal tax returns and 1 year of business tax returns rather than what you're being told, 2 years. Now, the third type of situation we're going to talk about has to do with the property type, and that's a condominium specifically. You might hear often that for someone to buy a condo, they have to put at least 25% down. Now, that's simply not true. The minimum down payment on a condo is actually 5%. The reason you were being told 25% is because that allows for the limited review of the condominium project. Now, to touch on that a little bit further, condo financing requires a condo questionnaire to be completed for the lender. The typical condo questionnaire is about 35 questions that talk about things such as the reserves, the budget, number of renters, number of delinquencies, really anything we as a lender would be concerned with when it comes to lending in that property. Now, by putting 25% down, you'll avoid that review altogether, and they're simply asked 5 questions. Now, these aren't questions that are going to necessarily disqualify the project or the property. It's a lot more simple. It makes for a much more streamlined process, and that requires the 25% that you hear most often. But this also is simply not true. We're able to do that same limited review on condominiums with as little as 10% down. There are very few individuals who have 25% to put down on a property. 10% opens up to a much larger pool of individuals. Is going to help you, once again, close more transactions on an annual basis. So hopefully you'll take the information you learned today and use it in growing your business into the future. But if you've had any clients who were turned down for financing in the past based on any of these 3 reasons behind me, it might be worth revisiting today. Give us a call to answer any of your mortgage-related questions. We're available 24/7 and looking forward to hearing from you.